Exchange-traded funds (ETFs) that focus on options-based strategies have been gaining popularity recently, and Roundhill's zero-day to expiry covered call ETF (xdte) is one of the latest entrants in this space. With a staggering 28% dividend yield and a 12% decline since inception, many investors are eyeing it as a high-yield opportunity at a discount. In this video, we're going to break down the fund strategy, the risk-reward profile, and whether it presents a compelling buy for income-focused investors. So what is xdte? The Roundhill S&P 500 0 days to expiry covered call ETF is an actively managed fund designed to generate high income by employing a daily covered call strategy on the S&P 500 index. The fund primarily focuses on 0 days to expiry options, which are same-day expiration options, meaning that it expires the same day they are sold. This allows the fund managers to collect option premium every single day, and it's distributed every single week. And also in this video, we're going to go over why I believe xdte is a great buying opportunity, especially in this volatile market. Because we're selling covered calls, we have the opportunity to make a lot of income potential by harnessing volatility. This means that the more volatile the market is, the more option premium and income we will be receiving through distributions. If we take a look at the distribution history, we can see that the distributions have been slowly increasing with the volatility of the market, and this recent payout is going to be one of the highest at 32 cents per share. Now, because this is an actively managed ETF and the fund managers are writing these call options for us every single day, we do have to pay a hefty expense ratio of 0.95%. But later in this video, once we compare the total returns to the S&P 500 index, we will see why we're actually okay paying this high of an expense ratio. First, we have to get into how xdte's strategy actually works. So they actually utilize a synthetic covered call strategy on the S&P 500 index, which means they hold long call options with a longer expiration date, and they sell short-dated call options against that long position. This is known as a poor man's covered call, and a regular covered call would actually own 100 shares of stock per sold call option, but this is not the case. We won't be getting into options and how they work in this video, but just know that we do have a long position and we sell daily call options against it to receive daily income, which is distributed to us every single week. Now, this is one of my favorite ETFs for income, rather than some of those by YieldMax, especially those single stock ETFs that sell cover calls, such as TSL, and that holds a lot of risk. With this ETF, you have exposure to the S&P 500 because we do have that long call position, so we are tracking the S&P 500 index, and it is watching the S&P 500 index very closely. If we take a look at the total returns, we can actually see xdte is beating the S&P 500, ticker symbol SPY, by over 1%. And that's because with the recent volatility, we're receiving high distributions every single week, as we saw earlier. So in addition to that stock appreciation, we are getting dividends every single week. This most recent upcoming dividend, we're receiving 32 cents per share. So if you hold 100 shares of this ETF, you're getting $33. And the previous week was 24 cents per share. And we did have a lower week because it was only a 4-day trading week at 14 cents. But on average, it's been around 20 to 30 cents per share. And that is a pretty good amount that you're receiving in income. But as we mentioned earlier, xdte tracks the S&P 500 index. So that means we do have exposure to the downside. So we're down 12% since inception. And this proves to be a great buying opportunity, especially for investors who are looking to get into this fund, or investors who are already holding shares of this ETF and would like to bring down their dollar cost average to lower their cost basis. Because remember, Most of the money is actually made during volatile and bear markets when stocks have been taking a beating. Many investors panic and they sell out of their positions when their stocks are down, but personally, it's the best time to buy more of your positions. And another good point to bring up is to actually always hold some cash on the sidelines so you can end up buying dips such as this. You never want to use 100% of your cash reserve on stock positions. Always keep at least 10% for opportunities such as this. And that's really when you're going to be building much of your wealth by getting shares of stocks, not just xdte, but any of your favorite ETFs, any of your favorite stocks. That's really where the wealth is going to be built. However, there are some risks to consider before investing into xdte. Some people are not a fan of a covered call strategy because it does cap your upside potential. Say the S&P 500 rises 50% in a month, which is of course unlikely, but if it does happen, xdte will not rise 50% in stock price. It will only rise maybe 10% because we do have that covered call, and that forces us to sell our position at a lower price. This ETF is great for income focused investors. You can use it as a supplement to your 9 to 5 job's paycheck, and this is better than receiving a paycheck every 2 weeks because you're going to be receiving a nice paycheck every week. So if you're living paycheck to paycheck, this can help out greatly because you don't have to wait 2 full weeks for that biweekly paycheck, and you can immediately pay off your bills using xdte's option income. If you're considering adding xdte to your portfolio, it's wise to monitor its premium income stability over the next few months. You also want to compare it to other covered call ETFs, such as JEPI, which is the JP Morgan Equity Premium Income ETF, and it sells covered calls on the S&P 500 index as well. But with this ETF, you're going to receive a lot more stock appreciation. In return, you're going to have a less dividend yield of only 7%. So that's an option to consider. Another option is actually going to be the S&P 500 Core Premium Income ETF. And this is by Goldman Sachs. It's their competitor to JEPI and xdte. As we can see, it does have pretty good stock appreciation, but you're going to have a lower yield of 8%. And finally, it's always great to consult a financial professional to ensure it aligns with your risk tolerance.